It is 6:50, and this is the November Finance Committee meeting. I'm Steve Miller. If the committee members and administration want to introduce yourselves on roll call.
Julia Olafson.
Ashley Godfrey. Kathy Hay.
Brett Cooper.
Okay, we have two items on the agenda tonight. Let's get started with the audit presentation.
Good evening. Thanks for having me. My name is Chris Herb. I'm a partner with Maley LLP. Very happy to be here tonight to present a summary of the 2021 audit. You do have a 5-6 page summary. I'm going to kind of aim most of my comments at that. Pretty concise summary of where we're at with the audit. This was our first year conducting Daniel Boone's audit. So just for a little bit of the behind the scenes, we came in, had a couple of meetings really before the year had even closed, just to get our hands around sort of the getting to know you step, having conversations and discussion about internal controls, policies and procedures over everything from cash disbursements, cash receipts, payroll, bank recs, really anything that impacts your numbers. We're just trying to understand how the school district sort of accounted for its records. We also build our perm files at this time, look at debt agreements, employee agreements, employee handbooks, CBAs, everything of that nature, just to kind of get our hands around everything. We did discuss with your prior auditor as well. We did get some records from them so we could make sure that everything was seamless and we were picking up right where they left off. They were very cooperative. We got everything we needed in that regard as well. And then taking, all those different pieces, we started looking at numbers and put together a very lengthy document request list for the business office. Everything from bank statements and reconciliations to W-2s and individual invoices. So a pretty lengthy list. We, again, got everything that we needed to conduct the audit, which results in the report. And the first page of this summary is a summary of that report. On the financial statement audit, that report expresses an unmodified opinion. It's also known as a clean opinion. It's the opinion you want to have on your financials. What that means is that in our opinion, the statements are free of any material misstatement. They comply with GAAP, that's generally accepted accounting principles. They also comply with all Gatsby pronouncements. That's the Governmental Accounting Standards Board that creates all these sort of funky rules that governmental entities and school districts have to follow. There's, again, no scope limitations. We received everything we needed to be able to conduct the audit. There is an emphasis of matter, in our opinion. It's exactly what it sounds like. It's not a bad thing. It's just our ability to emphasize a matter to a reader. We did implement a new Gatsby this year, a Gatsby 84 for Fiduciary Activities. Pretty minor impact overall. Really what that did on your fund financials in your fiduciary funds, which present these scholarship and student activity funds. In the past, you've always presented just a cash, whatever cash you're holding for those purposes, and an offsetting liability. What Gatsby 84 did was it said, well, you can't do it in that way anymore. You have to kind of treat it the same as all your other funds. So now there's cash, there's a fund balance, and then we also now present a revenue and expense schedule for those funds. So pretty small change, but that was a change that we made this year. No instances of non-compliance material with the financial statements were disclosed during the audit. We would have to have those in the audited report if there were any. We did not have any this year. And no findings, no significant deficiencies or material weaknesses related to the audit. There was a finding last year from your prior auditor regarding general reconciliation of accounts. We did look at that as part of our audit. We felt that had been properly resolved this year. When we came in for the audit, we received, again, support for everything we needed, reconciliations to tie to various balance sheet P&L accounts. If something was missing, we were informed up front, hey, we're still working on that, which is fine. That's not a problem. You're allowed to work on some of those year-end reconciliations. So again, we did resolve that finding this year. The Uniform Guidance Audit, also known as your single audit or audit of federal awards. Again, this is a unmodified opinion on that. No significant deficiencies or material weaknesses related to internal controls. You are not a low-risk auditee. That's a result of prior findings in the prior years. So we ended up auditing 2 programs this year. One was the Child Nutrition Cluster. I was on the Federal Audit Clearinghouse earlier tonight because I was trying to figure out when the last time was that was audited. I couldn't quite figure it out. The rule is if you have over $750,000 of expenditures, you're a Type A program. Child Nutrition Cluster had previously been $400,000 or $500,000, so it never required an audit before. But with the pandemic and the way you were getting reimbursement from the federal government under the pandemic rules, your expenses for the Child Nutrition Cluster went up significantly. It was a must. We had to audit that program this year because you were over the dollar thresholds. We also audited Title I. The reason for that is when you're not a low-risk auditee, we were required to audit 40% of the dollars spent, the federal dollars spent. So this year we decided we'll look at Title I. There had been some findings not last year, but in the past for that. So we chose that program just to give it a once-over, make sure everything there was working okay, hit the 40%, and my guess is that sort of kind of clears the decks for when we have to start auditing the ESSER and CARES money coming up in the next couple of years. The next page, just wanted to go over a few of the estimates that are in the report. Capital assets, depreciation, accumulated depreciation, cost of all school district assets, about $129 million. Depreciation on that's about $63 million. What that tells me is you're just a little less than 50% through the useful life of your assets. Net pension liability, this is your slice of the PSERS, unfunded pension liability. At the end of last year, it was about $73 million liability. It went up to about $80 million this year. Really the reason for that is timing. One thing to keep in mind is your June 30, 21 school district financial here actually presents June 30, 2020 PSERS data. So 1 year look back, it is designed that way. It's allowed under the Gatsby rules. But what that means is we are reflecting a net pension liability on your books that was 3 months into the pandemic. Not where we're sitting now, 15 months later, know your year end. So, those initial few months of the pandemic, lots of market fluctuation. So when the markets got hit a little bit, that would increase PSERS net pension liability, and then you, again, get your little slice of that like every other school district. So that increase, not uncommon, every school district that's in PSERS, I would imagine, saw very similar percentage increases year on year. Net OPEB liability, 7.3 versus 7.5 million, so pretty flat. Compensated absences is the other estimate based on banked compensation time, low 800,000 both years, so no big changes there. The next page, I have just a few charts showing some revenue and expense activity year on year. This first chart is revenue composition for your governmental funds. Total revenues for this year, $59.2 million. It was down about $7,000 from the year before. I don't know that I've ever seen revenues this flat. Very consistent year on year. There was a small gain in real estate taxes in that local column, but then it was completely offset by, again, market fluctuation. You lost about $300,000 in investment earnings year on year. So any gains in real estate taxes were kind of wiped out by the decrease in investment earnings. State sources, that's your basic ed, your special ed, again, all very flat year on year, and then your federal sources. That blue column, which is this year, is up a little bit. It's up about $300,000. That's related to some of that ESSER money that's starting to flow out to the schools. Expenditure composition, the next graph there, $59.9 million of total expense in your governmental funds for 2021. Up a little bit, it was about $58.4 the year before, so up about $1.5 million. And you can see down below the blue columns, which are this year, are all a little bit higher than the orange, which is last year. Instruction, the first set of numbers, went from about $35 million to $36.7 million, about a 5% increase. Support services went from about 16.2 to 17.3, about a 7% increase. That's pretty typical school district increases when you figure salaries, benefits, things of that nature. The last column there, debt service, actually did decrease. This was $7.3 million last year, went down to $5.9 million, about 20% decrease. And really what that's driven by is last year and this year you did a lot of debt restructuring. This year your debt actually went up from last year to this year. So you have more debt, you had less expense paying down your debt. The next page, talking about debt again. Just a quick graph on bonds payable year on year. You had $67.9 million of outstanding debt last year. It's up to about $69.5 million this year. You did have 3 issues this year. There was a 2020A that was issued for $14 million. There was restructuring portions of the 2016, 2017, and 2019 bonds. And that 2020A, because of the way that restructuring worked, did result in a cash flow savings of about $3.2 million. 2020B, you took out for $2.5 million to restructure the 2017 A bond. That resulted in an increase in future cash flows of $742,000. And then the last issue, 2021, $5.8 million refunding 2016's issue, decreasing future cash flows of about $1 million. The graph below that, fund balance. Again, fund balance is the difference between assets and liabilities in any fund. So the blue line, that top line, that's your general fund. Went from about $6.5 million 2 years ago to $7.7 million last year to $8.4 million this year. So climbing pretty steadily, at least over the last 2 or 3 years. That $18.4 million fund balance at the end of this year represents about 14% of expenses, about 1.7 months. That's, I've seen guidance that usually 2 months worth of expenses is kind of the goal, the sweet spot. So you guys are kind of moving closer to that, which is, I think the right trend. A couple years ago, I probably would have been, and I don't know if someone was, I'd probably be saying, hey, 6.5, a little low. When you get down to about 1 month's worth of expenses. But 2 is a good goal. You're on your way there. Capital projects, which is that middle orange line, very flat. It's about $3.3 million of fund balance every year. And then the bottom gray row, that's food service. It's flattish. It's around $300,000 of positive fund balance, which is actually, in my mind, really good. Most of the school districts I work with, that's negative. The result of healthy food initiatives, depreciation on assets, things like that. Be hovering around $300,000 of fund balance for a food service fund. I think it's really good. The last graph here, this is your governmental activities. So very similar to fund balance, this is the difference between assets and liabilities, but this is based on the government-wide financials. So this includes debt, capital assets, the net pension liability, net OPEB liability, everything. So you can see June 30 of 2019, it was actually negative between 73 and 74 million. The reason it's negative is because of that massive net pension liability and OPEB liabilities that you pick up in PCERS. So the next year there was a gain, really, and really this line kind of goes however PCERS goes. So the next year PCERS did well, you gained a little bit of fund balance, it improved, it went down a couple $2 million, and then this year, again, we had that bad net pension liability, so now the liability. But relatively, it looks like a big, kind of spike there, but you're generally around that negative $70 million. The last page is something that I just like to show to some of the people I present to. Some people like it, most people like it, some people don't, but just wanted to kind of give you an idea of some of the things we're doing behind the scenes on the audit. When it comes to the balance sheet, your assets, your liabilities, tying a lot of that out to schedules, reports, things of that nature. Revenue is very easy to audit as well. A lot of that we can confirm when we get information from PDE as far as grants. Expenses are always sort of the hard thing to get our hands around from an audit perspective because so many expense accounts, so many vendors and things of that nature. So one of the things we do, we rely very heavily on data extraction and analysis. What we do as part of the audit is we get a complete general ledger report from the business office. That's a schedule of every individual transaction that the school district has. We put it into this software, and it allows us to sort of manipulate and put the data in a bunch of different ways. This first graph here is called a Bedford's Law test. It's one of the things we do in the background. What Bedford's Law says is that in any large randomly occurring population of numbers, the first digit will be 1 about 30% of the time, whether it's $1, $10, 100, 1,000, 10,000. And then it starts to drop off. First digit will be 2 about 22% of the time, 3 about 17% of the time, and it goes all the way down there. That's an actual graph of every individual transaction in the school district for the June 30, 2021 school year, and you can see it follows that graph perfectly. If the software felt that something was out of line, it would be turning one of those columns orange. Orange if it's a little worrisome, and red if you're really far out of line. Everything there is blue, so everything there is fine. What we end up doing, because this always ends up fine, I've never not seen this all blue. We end up doing the first 2 digits.
Sorry.
1, 1, 1, 2, 1, 3, 1, 4, all the way up to 99. That's where we'll tend to get some spikes. That's where we'll get the little orange and the red columns. And most often it's recurring payroll items, those things that happen every 2 weeks. Same dollar amounts, every period. But we do investigate them. So that's one of the things we're doing behind the scenes. We have a list down at the bottom of some other things we do. Pivot table analysis. We can sort your expenses by function or object code, look at them from month to month. As we have more time doing your audit in additional years, not only will we be able to look within the year, month to month, but we'll also be able to compare each month to prior years. So again, it's just looking for unusual activity, unusual spikes or valleys, and focusing our testing there. Predictive Analytics, we'll start comparing year-to-year activity, looking for, our expenses trending up, our revenues trending down or up, or what would it be? We come up with a prediction of what we think the year's activity will be, compare that to actual results, and then if something varies, that's where we'll test. We also look at W-2s, journal entries, vendors, we look at duplicate payments, and it's all about sort of, again, because expenses in particular are so hard to get your hands around because there's so much volume, it's really about making sure we're not just testing the same expenses or the same vendors year on year, but it's a risk-based approach that really lets us look at the numbers and let the numbers take us where we want to go. So, again, just something we work on now, it's something we do as part of the audit. With that is the end of my presentation. I'd be happy to field any questions if there are.
I do have one question. Fund balance has always confused me, and I see with the end of the year 2021, general fund balance is still increased. We didn't raise taxes in 2021, and we used fund balance to cover the gap. So how does it increase?
You've had net income over the past few years. Now, when I showed you the revenue expense information, I said revenues were pretty flat, expenses went up. So the net income did drop off, but it's still positive. You still are showing income year on year. So as long as you're showing income year on year, that fund balance should tend to creep up.
So even without a tax increase that year, that additional revenue from growth or
it can be assessed value. That's usually what I attribute to.
home sales, yeah.
Yeah, and there is transfer tax in there as well.
Okay.
The home market, I live here. The problem is, transfer tax has boomed a little bit, but man, there's just been no inventory here.
Oh, yeah.
So if there had been more inventory, maybe you could have seen that number churn up. So
Yep.
really, I would anticipate that being relatively flat. Probably transfer tax is dropping off a little bit, but it is.
Okay, just curious. So we've been using fund balance year over year since I've been here, but it still tends to increase. So
Yeah.
Okay, thank you.
Sure.
Any recommendations?
Um,
Usually when you see these, there's something somewhere, recommended that, we make this adjustment or do something different. Any recommendations?
We do have one thing that we talked about that we're going to work on for next year's audit. It was interesting. one of the things we talked about was how things went with the prior auditor. And one thing that you had mentioned to me was the CFA schedule. So that schedule of expenditures of federal awards that's in the back of the report, you would provide the auditors with one, and then they would change it, and you didn't really know why. So as we were going through the audit, we started to realize there was things on the CFA that weren't flowing from the prior. And as we started to examine the way the grants are recorded, and on the CFA, really almost for every grant you show 2 years worth. You show, okay, here's what was left happening with the 1920 grants last year, any money that was left to receive, things like that. And then here's what's happening with this year's grants, Title I, Title II, et cetera. So what we found was the presentation on the CFA schedule was being changed in the past, but they had never really, my impression is they never sat down with Kathy and really talked through it. So we did that this year. We kind of came to the business office and said, hey, here's what we're changing on the CFA. Here's why we're changing it. And kind of gave that to them to review. I think we're of a consensus the way that's presented now is correct. So probably the biggest change for next year that I'm recommending is before they even start putting together that CFA schedule, I've already put it out to them, give me a call. I'm going to come in before anything starts getting laid out. Let's just talk through the concepts of presenting each grant year separately, picking up with 1 year, making sure the receivables and deferrals are corrected, making sure we get that CFA schedule nailed down. That's probably the biggest project I have in my mind for next year. Yeah. But I do want to point out, when we do have an adjustment for that, very small adjustment, and it's on the SAS 114 letter we're going to be issuing, but it wasn't material, and it didn't impact revenues or expenses. Really, it just impacted the balance sheet moving between grossing up or down the assets and liabilities.
Yeah, I'm not looking for a problem.
Nope.
You always look to make, how do you do better? How can we improve? Continuation of improvements.
Yeah.
We'll make sure we want this.
Definitely not something I see as a problem, just something that I think we can do a little better going forward.
Awesome. Thank you.
Sure.
Thank you.
Absolutely.
Okay, with that, I did want to, of course, the audit will have to be brought out, hopefully to the next voting meeting to vote on to approve the audit so we can move forward with that. But in that, with that approval, I was looking at moving $1 million to capital. With the audit, I want to put that in the audit, present it that way, with the $1 million out of the unassigned, and move it to capital for future capital projects. We have several that are coming up. We have like the track, which is probably going to be between 800 and $1 million. The track itself, we've already done the field, but we still need to finish that track. We've got the HVAC units. There's 1 unit in every room. Of course, we're doing about 3 to 4 every year. And then you have the ed roofing project. Well, that's all the time. And I think the wall at the IC is the other one. So just some general ideas of some of the projects that are coming up. I think it would be useful to put it there, and understanding that you can take that back if something happens. The board can vote to move it back into the unassigned if necessary. But I feel going forward with the budget where we are, can't make you promises, but as I'm looking at what the numbers are coming in, I believe we can keep that budget flat this year. And I would imagine we wouldn't have to do a mill increase this year. So that's where we stand now.
Okay.
My recommendation, and I'm hoping that you can vote that we can move the $1 million to in the next meeting.
I would have no objection to us
Okay.
recommending that out.
Good.
How do you feel?
Yeah, that seems fine.
Here, I agree. Makes
You don't
sense.
get a vote.
I don't vote. All right.
All right, and Ty, too, you saw in your email that Ty can do all that there to the AFR. So I take what he gives me and my financial statements in the system, I tie it together, and that's what the AFR, and there's no validation, so I match what he says, he matches what I say, and there's your final report to the state. So it would be approving the AFR, the audit, and the $1 million transfer be brought up.
Sounds reasonable. Yeah.
Okay.
Okay.
Awesome.
All right. Thank you.
We're good.
All right. Well, thank you very much.
Thank you.
Thank you, sir.
And the last item I have on the agenda is the vision.
Right.
Now, I gave everybody one of these handouts. What we currently have, now vision is not a major expense on our budget. You're talking about 15,000, 20,000, 15,000 about every year. Which isn't like a huge expenditure. What I'm suggesting, or what I'm asking to be approved, is to switch from what we currently have right now, which is Davis, to what the plan is VBA. We're paying $15,000 a year for a benefit that nobody's getting anything out of. So you don't have a lot of usage, so it's kind of like a waste of money. This is a more enhanced version, and it gives the employee the option of buying up for themselves, but also buying up for their family. We would pay the same, or actually it's going to cost us $400 less a year for the district to pay for the employee, but if they choose to buy up, they pay the difference. So what I'm asking for is this to be brought out so we can sign this agreement, so I can have an open enrollment starting January 1st. The reason I'm doing that is because I want to make sure that sometimes when you do an open enrollment in May, I don't think that sometimes people just kind of blow past it. So I want to give it a double opportunity for people not to blow past it. I want to make a big to-do about it right now. Send all the emails out. Hopefully we'll get a lot of people to sign up. If not, they have that second opportunity in May after the friends have talked to friends and employees to employees and see how great the program is. We'll get more buy-in for people to come in and do it in May. It's kind of a double hit in 1 year.
So, the way it is now, it's like just the employee as you've laid out. So if the employee is automatically enrolled because it's at no cost.
Right.
So the open enrollment period we're talking about is to bring in spouse, dependent.
Or buy up for the second plan.
So there's no need.
Two plan project. Yeah.
Right. So there's no reason for the no cost option for them to do anything. It would just roll over to the new.
Roll right over.
Okay.
But
I just wanted to be
give them
sure.
an option. I want to give them the opportunity twice in order to do it, just in case. Because
Yeah, no, I
a lot of people
understand.
don't understand it, and I get that.
Just as long as it's not a,
No,
as long as
I'm not asking anything
it's
from them.
opt in just for the extra stuff.
No,
That makes sense to
I'll
me.
automatically put them into the new program. They'll get all their, whatever their literature that they need to operate the new program as an employee. That is identical. I did send this out to both unions, and neither one came back with some questions, but I've satisfied everybody.
Nobody had an objection. I don't see where they would, honestly, by looking at this.
It's a very good benefit, it's a better benefit.
And you said it's cost neutral, or we're saving money?
$400.
$400.
It's not a lot. Like I said, this is not one of our
No.
expensive benefits.
Right, no.
Are there providers, like, is it more providers available?
Yes, I have the list. I already sent that to the teachers union, so there's a lot more. It's not that there's a lot more providers. Like, Davis used their own labs to produce lenses. But with this one, they have all these different name brands in different places. So instead of not getting anything where you would if you went to your own eye care or whatever, you're now going to get something. And then the other thing is you can go once a year to in one of the options is the once a year instead of every 2 years.
Right.
Oh, okay.
So it is definitely, there's nothing less that we have to worry about.
Right.
And I did make sure that I passed it through both unions. So I'll just need someone to sign off on that and bring it out of here, of course, vote on it, make sure everybody's okay. And then I have the contracts here.
Yeah, I would have no issue with making the change.
No, I agree. Anyone? No? Okay.
Awesome, that's all I have.
All right.
Any other business to cover for the Finance Committee?
Is that what everybody?
No? Hearing none, that concludes this month's Finance Committee meeting at 7:19. Thank you.
Yeah. It's
Just what I want hanging out of my
that pop off.
They can give me a dollar.
Sometimes it.
We refinanced our My son was really excited. Yeah, Sam got it.
Oh, actually, it's still on.
There's one of them that gets tricky.
Yeah, this one's Yeah, he's in the office division, so I'm not sure how you know.
They had their tournament this weekend. Travel. They lost the only loss they had all season. They weren't.
Huh, that is weird.
Shut down, yeah. Back up and